Longer going to be an episode of Chair Too Low, Lights Too Dim. I'm actually in a place with decent lighting now, and hey, I've got the board mounted on a wall. It is a bit small, I apologize for that. Might upgrade in a little bit, but today we have um, more of a serious topic, but I'm going to be talking about 5 stocks that I do not want to buy in November of 2019. So I'm not going to do any suspenseful things with my list. So right out the gate, they're Coca-Cola, Netflix, Visa, Amazon, and General Electric. So some of these are big names, some of these are names people might be kind of excited about now, and some of them, like Visa and General Electric, might not even be on people's radars right now. But let's just jump in to Coca-Cola and why I will not be buying this month, or probably anytime in the near future, really. I've been wanting to buy Coca-Cola for a long time. It pays great. It's known as a great dividend stock. Like, it's right up there with Verizon. People have Verizon and people have Coca-Cola, and they get great dividends from both. And I have been waiting for over a year now to buy Coca-Cola, and I haven't been able to do it because of this number right here, 29 price to earnings ratio. All these numbers here are price to earnings ratios. That one, I mean, that's a 0. Should just be not applicable to GE. Well, according to Robinhood, GE has a price to earnings ratio of like 340-ish. According to Yahoo, it doesn't because it's still negative for the past year in earnings. So I'm going with Yahoo Finance because we all know Robinhood with their price to earnings ratios can get a little weird. All these are pulled from Robinhood, so there may be a couple points difference, but not really enough to matter. But Coca-Cola with the 29 price to earnings ratio, this is something I touch on in I say all my videos, but it's something that's going to be touched on in almost all my videos about these is the price to earnings ratio and people's disassociation with what a high price to earnings ratio is. So when you have Netflix and Amazon as both awesome big name companies that people want to invest in, trading at 92s and 79s, it makes 29 seem really reasonable. It's not. For Coca-Cola, I would have a hard time paying over 20. A 20 price earnings ratio with Coca-Cola would still be high to me. Like a 15 would be a bare minimum for me to want to buy Coca-Cola, like maybe 18, between 15 and 20 if I'm really just looking for the dividends. But when we're talking a 29 price to earnings ratio, and actually until basically just this month, it's been over 30. It's been over 30 price to earnings ratio. And to me, yeah, I would get my dividend, and yeah, I would be planning on holding it for a long time, but that's going to come down. Coca-Cola, they're coming out with some new products. They're actually just over the past couple days, their stock got a little bump because they announced a caffeinated seltzer water. So they're jumping into that game, kind of trying to reinvigorate the sparkling water or their sparkling water brands. But that's not enough. You're not going to convince me that Coca-Cola is going to do some magic growth where their price is going to go up and their price to earnings ratio is going to go down that way, or their earnings aren't going to go crazy. What's going to happen is their price is going to come down. It's going to happen sooner or later. Their price is going to come down. And I'm just going to wait for it. In a year, it may take a year, but at some point, Coca-Cola is going to be back down to a 15, 16, maybe 18 price to earnings ratio, and I'll be able to do another good assessment of it, and I'll probably pick some up because I love my dividend stocks. I would love to own Coca-Cola, but I would not like to buy Coca-Cola at a 29 price to earnings ratio. Next up is Netflix, and it's going to be a reoccurring theme. Some people have their pet peeves, their pet stocks. My pet negative stock is always going to be Netflix. I say always. I mean, everything evens out in the end. But Netflix right now is just absolutely ridiculous. A 92 price to earnings ratio? Definitely not happening for me. You can't. Netflix and Amazon honestly have had about the same problem for me when I look into them to invest in them. Their year over year growth doesn't justify something crazy like 92. It doesn't. It's when you buy at 92, you're basically not going to see profits unless the stock continues to go up for several more years. Your profits aren't going to be locked in. You may not even see profits, especially when you look at Netflix. They're over the past year, they've really kind of tapered off. Their stock price hasn't really gone anywhere. You're kind of starting to see that it's kind of leveling off, and I think best case scenario for Netflix is if there's not a correction, if there's not a dip in the market, if there's not a recession, Best case for Netflix is that their price is just gonna keep going. Because let's see, we had a big jump, then they kind of the mid 2018, end of 2018 correction kind of took them down here, and then they kind of got up to here, and now they're kind of right in there. Best case scenario for Netflix is that it's gonna just keep doing this as earnings go up, and that's going to be what brings their price to earnings ratio down. What I think is more likely to happen is that there's going to be a correction, Netflix price is going to take a big hit, and they're going to come down to something a little more reasonable. I think that something more reasonable is going to hold fast at 30 to 40 for a little while, which is still a little ridiculous in my mind, but Netflix is not going anywhere anytime soon. I bet on that for probably, unless there's a huge correction, at least a year. Next up is Visa. This one is kind of the odd one out because not many people talk about Visa, but if you're in the financial stocks, it comes up. I like Visa. I first got into Visa because I liked the idea that it's in the credit card game without as much flesh in the game. So to me, Visa, and of course I'm not getting way into depth in these policies that they have or their actual business models, but to me, Visa is a lot more recession proof than companies that have a lot more skin in the game, like MasterCard is another good one, kind of like Visa, but especially when you look into like Discover, American Express, they have a lot of skin in the game and a lot to lose in the event of a recession. But Visa, I like it because it does pay dividends, pays small dividends, but dividends nonetheless. I built my position for Visa in 2016-ish time frame, and from there it's kind of skyrocketed. Right now I'm at like a 60% total gain for my lifetime on Visa, and I would like to add more. I really like Visa as a company, but right now it's just a little too expensive at 34, because really their big growth over the past few years has been in foreign markets, and eventually that's going to slow down. I don't think, or even if it stays the same, I don't think it justifies that 34, even though everybody's calling it a buy right now. I don't think it justifies the 34. A little too risky for me. Next up, Amazon, and this is one that, I don't know, I haven't heard a lot of buzz around it. I take that back. There's been a little bit of buzz, but the negative buzz. There has been a little word of it on it falling because it has big competitors entering the market, namely Walmart, but then you also have your local like Walgreens that are trying to get into the delivery game. But Amazon, at a 79 price to earnings ratio, has the same issue that it had back in 2017 when I was originally looking at investing in it. And I could have invested in it then and made a bit of money, but when I really looked into it again in the beginning of 2018 is when I just said, no way, I don't see it. And it's kind of the same problem as Netflix. Now, I'm not as negative on Amazon as Netflix because Amazon does have a lot more businesses, especially in the past 2 years, they've really introduced services and different, what was the thing I saw today? So Amazon Wardrobe, is that what it's called? Just different branches of business where they can bring in a little bit more profit. But at 79, again, when I looked at the stock originally to invest in, there were two things that kind of stopped me from investing in it. The big logical reason was the high price to earnings ratio. When I looked at the rate that Amazon was growing, I had to really assess, okay, well, if their price to earnings ratio is this now, how long in the future do I have to wait before I feel more secure in my investment? Because, if I invested in Visa at a 34 price to earnings ratio and all of a sudden it exploded and gave me 100% profit, but now its price to earnings ratio was 100 something, I'm not comfortable with that. I would want to sell immediately because that isn't sustainable. It's going to drop. Price to earnings ratios will always come down to a reasonable level, or earnings will have to jump to make up for it. You're not going to sustain a crazy high price to earnings ratio and keep growing for years on end. So Amazon, I was looking at that and I was like, the price is kind of built in for the next few years, and I wasn't really interested in that. The other thing was, I'm kind of a small investor. My portfolio is about $40,000. So each position I build up is around $2,000. If I have more faith in the company, I'll build more. If I have less, I might build a little less. I'll get into that in another video. But Amazon, as we all know, is a very expensive stock just to buy. I think right now it's about $1,700. Don't quote me on that. But it's expensive nonetheless. So when I was first getting into this and looking at Amazon stocks, I could either buy Amazon and have 2 stocks, or I could buy something else. At that time too, I was looking at Microsoft. So I could buy like 10 Microsoft stocks to 1 Amazon stock, which gives me a lot more flexibility. Even if Amazon stock goes up 20%, it reaches a price point over a time period where I'm comfortable in starting to sell it off. You can't really start selling off 2 shares. I mean, what are you going to sell, one and then not the other? Whereas with Microsoft, if I ever felt like it, which I haven't yet, if I felt so inclined, I would be able to kind of, if I have 100 shares and it reaches a good price point and I want to invest in something else, I can sell 10 shares and start another stake in another stock. Whereas Amazon is kind of all or nothing. You're stuck with it until you want to sell it. And the 5th stock we're talking about that I'm not going to buy this month is General Electric. I should probably clarify, out of all these companies here, the only 2 I own are Visa and General Electric. And the funny thing about my position in General Electric, I've been watching General Electric for about 1.5 years now, and I think they're nearing a turnaround point. I think sometime in the very near future, they're going to hit that point where people are going to look back at them and say, oh, I should have bought that stock then. So I just kind of opened a token investment in General Electric. I bought like 15 shares, I think. And it was literally the next like 2 days that it started shooting up. So I'm up a whopping like 23% on my General Electric shares over the course of a month. But that equals out to a whopping $18. So with that huge, actually I think over the past month-ish total, it's up almost 30%. So with it being up 30% in basically a month, I'm not buying more. It's reached a point where it's a little too volatile. I don't think a stock's going to jump up 30% over the earnings period and stay there. It's going to drop, just like I said about Tesla. And Tesla did. It dropped about 7% already. Could drop a little more, but with the truck news kind of pushing it along, it could go up. But just like that with General Electric, I expect it to go down again. Maybe not to where it was, but it's going to pull back from its earnings high. And that's when I may buy a little more. I don't have as much faith in General Electric as I do in some of my other bigger investments, so it's going to be a smaller position. But I do hope to get some more. I think General Electric is going to do good things in the coming years, but right now, definitely not a buy for me. Anyway, hope you guys enjoyed this. And if you guys have stocks that you just wouldn't touch with a 10-foot pole right now, please tell me what they are. And until next time, y'all have an awesome day.